Welcome to The Debate. Today we are opening the book on Consensus Cloud Solutions, Inc., or CCSI. For those following along, this is a cloud fax and secure document exchange operator. They were spun off from Ziff Davis back in October 2021.
Right.
And the central tension we are exploring today is a classic divergence of perspectives. Is CCSI a fundamentally mispriced, cash-gushing compounder that is just being unfairly penalized by optical balance sheet artifacts? Or is it a distressed, melting ice cube hiding an imminent debt wall and secular decline behind incredibly opaque disclosures?
Yeah, that is the core of it.
Our entire discussion today is anchored in the recently generated close-read report and screening data dated March 3, 2026. I'll be representing the fundamental long position, arguing that the company's massive free cash flow, operating efficiency, and extreme valuation discount make it a compelling fundamental long case.
And I will be taking the forensic and credit bearer position. I'll be arguing that, well, a secular revenue decline, atrocious disclosure quality, and unaddressed 2026 and 2028 debt maturity walls make this stock a textbook value trap.
Okay, let's start by looking under the hood of the long thesis, because the initial data is striking. When you run CCSI through our most rigorous quality screens, it passes with absolute flying colors. The company holds a grade A durability score, which places it in the 99.3rd percentile of the entire screened universe on page 1. The screening system formally assigns it to track 1, compounders.
The fundamental reason for this is their staggering free cash flow generation. We're looking at a free cash flow margin that expanded from 14.7% in fiscal 2022 to an incredible 30.3% on a trailing 12-month basis per page 4. That yields $106 million in pure, unadulterated free cash flow. And when we look at valuation using the Penman residual income model on page 2, which essentially measures the true cash a business generates over its cost of capital, assuming absolutely zero future growth, it spits out an intrinsic value of $1,112 million. Against the current market cap of just $451 million, that implies a nearly 150% margin of safety.
Look, I hear the enthusiasm for those numbers, I really do. But I come at it from a very different way. The machine learning model we use actually issued a reject signal for this stock on page 1, and I believe it is picking up on genuine structural distress. The income statement is frankly masking a terminal decline trajectory.
How so?
Well, if we just look at the top line, revenue peaked at $362 million in fiscal 2022 and has contracted ever since, showing a negative 3.4% drop through fiscal 2024 on page 12. That is the very definition of a melting ice cube. But the real issue here, the thing that makes this uninvestable for me, is the catastrophic credit and refinancing risk. The company's carrying $558 million in total debt against near zero equity, according to page 18. And most critically, they have a maturity wall of 2026 senior notes due exactly on October 15, 2026.
Right, the 2026 notes.
Exactly. We are sitting here in early March. That is just 7.5 months from today, and management has disclosed absolutely zero refinancing plan on page 19.
Okay, let me jump in there, because I want to address that reject signal you mentioned from the Layer 5 machine learning model. If you look at the actual data feeding that model on page 3, that signal is a complete artifact. The algorithm is rigidly punishing CCSI for having what it calls negative common equity to the tune of negative $79.5 million in fiscal 2024.
Right, it flags it as distressed.
But as fundamental analysts, we know that negative equity is strictly the result of aggressive LBO-style share buybacks. They bought back so much stock above par value that it drained the retained earnings account on paper. The ML model sees an undefined debt-to-equity ratio and throws a distress flag, entirely missing the incredibly healthy underlying cash flow. Can you acknowledge that the negative equity flag is purely a data artifact from those buybacks rather than a sign of actual operational distress?
I will certainly concede that the negative equity itself is an accounting illusion created by the buybacks. I'm not worried about the book value of equity. What I am worried about is that those buybacks drained cash that should have been used to pay down debt. And on top of that, the forensic red flags in their SEC filings are deafening.
The candor scores?
Yes. When you run the natural language extraction pipeline on their text, they get a dismal 4 out of 10 candor score on page 31. There are 0 extractable management claims across 4 years of 10Ks regarding revenue durability. They sit in the 0 percentile for business model clarity on page 32. Management outright refuses to disclose churn rates or the pace at which legacy fax is being substituted by modern technology. So you see a massive valuation discount and call it cheapness. I see that exact same discount and call it a risk discount. The market's implied growth rate is negative 4.43% in perpetuity from page 3. The market isn't stupid. It correctly sees the legacy cloud fax business steadily eroding into obsolescence.
So for the listeners tracking this, we have a classic standoff. You are looking at a ticking debt clock and technological obsolescence, and I am looking at a massive cash cushion and a market overreaction. Let's dig into that valuation gap. You mentioned the market is pricing in a negative 4.43% perpetual growth rate. That means the market expects their residual income to permanently shrink by nearly 4.5% every single year forever.
Exactly.
But my first hard question for you is this. If the market is correctly pricing in terminal decline, why has trailing revenue stabilized to a near flat negative 0.2% on page 12? The core fax business in healthcare and legal is incredibly sticky due to compliance and embedded workflows. The market is pricing this like a rapidly collapsing tech fad, but the cash flow proves it has found a highly stable floor at around $87 to $88 million per quarter.
Because stabilization for a quarter or two doesn't negate a structural trend. Let me throw a hard question right back at you. How do you explain away a single product company operating in a legacy technology that is actively being substituted by API-based workflows?
Well, they are transitioning.
And to translate that for our audience, an API workflow means modern software systems talking directly to each other, electronic health records exchanging data instantly, bypassing the need for digital faxing entirely. They have an HHI concentration of 0.333 on page 13, meaning they are incredibly reliant on this single endangered revenue stream. Even basic models are expecting severe earnings attrition. Look at the divergence in the Morningstar multiples provided in our screening data on page 5. The trailing PE is 5.15x, but the normalized PE drops to 3.92x. That is a 24% divergence, meaning the baseline expectation is that earnings are going to fall off a cliff.
I have to push back on those Morningstar metrics. Our screening data explicitly flags those Morningstar multiples as stale on page 5, so treating them as live market pricing is leaning on a known data artifact. But to answer your question about defending the business model against API substitution, you defend it by looking at the sheer quality of their operational leverage.
Go on.
Even if we accept the slight secular headwind on the top line, management is displaying elite countercyclical cost discipline. From fiscal 2023 to 2024, revenue declined by 3.4%, but operating income actually rose by 1.5%. How? Because they slashed their SG&A by 24% on page 14. They are maintaining a highly stable operating margin in the 42.6 to 43.0% band. But the real magic is their capital efficiency. They operate with a deeply negative cash conversion cycle of roughly negative 168 days.
A negative 168 days?
Exactly. For the listeners, this is the holy grail for a mature business. It means their days sales outstanding is 25 days. They collect cash from customers in under a month. But their days payable outstanding is 193 days. They take over 6 months to pay their own bills. Their suppliers are effectively acting as an interest-free bank, financing a 5-month working capital float. So here's my second question. Are you seriously betting against a business that operates with a negative 168-day cash conversion cycle as detailed on page 16?
I absolutely am, and I'll tell you exactly why. Stretching your payables to 6 months is not a structural advantage. It is a finite lever. Eventually, vendors demand to be paid. Just like cost-cutting is a finite lever. You can only cut SG&A so much before you hit the bone. And it's masking a much more disturbing trend, structural COGS creep.
COGS creep?
Yes. According to both the Compasta and SimFin data on page 17, their gross margin compressed an astounding 670 basis points, dropping from 86.8% in fiscal 2022 to 80.1% in fiscal 2024. So here is my second question to you. How do you justify a 670 basis point compression in gross margin if their pricing power and workflow integration are as sticky as you claim? If customers love the product, margins wouldn't be degrading that rapidly.
The gross margin compression is a known side effect of scaling up their newer, more secure exchange platforms which have higher initial hosting costs. It is a mix shift, not a loss of pricing power, and frankly, the absolute cash generation dwarfs that margin shift.
But even the free cash flow data itself has artifacts that warrant extreme caution. The Morningstar data reported $98 million in FCF for fiscal 2024, but the CIMFIN data reported $88.3 million on page 6. That is nearly a 10% discrepancy right there. And if you look at the quarterly seasonality, their Q4 cash flows structurally trough every single year. So my third question is this: what happens if you catch them at the wrong point in the working capital cycle, given that Q4 cash flows structurally trough every year to just $3 million as shown on page 15, right when a debt payment is due?
The discrepancy between Morningstar and CIMFIN is simply a definitional timing artifact regarding how they classify certain capital expenditures. It doesn't change the directional reality that this company is a cash machine. And speaking of directional reality, let's address the elephant in the room: the balance sheet. I know the credit risk is central to your thesis, but the metrics have steadily improved. The net debt to free cash flow ratio actually fell to 4.6x on a trailing basis on page 18. That comfortably passes the screening system's 6.0x veto ceiling. Furthermore, their interest coverage has improved from 3.0x in fiscal 2022 to a very healthy 4.8x today. So for my third question, doesn't the fact that their net debt to free cash flow ratio fell to 4.6x prove they are successfully delevering and managing the balance sheet responsibly?
Falling from heavily overlevered to just highly levered is